Hey guys, in this video we're going to talk about buying LEAPS options instead of stock for better return on investment. When most people think about investing, they're thinking about buying stock. While this is a sound strategy, there are other options available that can be just as profitable that use less capital and have fewer risk. LEAPS stock options do exactly that. So in this video, we're going to take a look at LEAPS options and why you should consider using them instead of actually buying the stock. We're going to talk about what are LEAPS stock options, why should you buy LEAPS options instead of stock, what are the benefits to LEAPS options, what types of stocks are best for LEAPS option trades, what is the optimal way to put on a LEAPS option trade, how you should manage LEAPS option trades, and what are the risks along with LEAPS options. We'll also do a real example of a trade on the Tastyworks platform. Okay, so what are LEAPS stock options? LEAPS are long-term equity anticipation securities. They are options with expiration dates that are much longer than the standard options contract. The acronym LEAPS, it's not plural LEAP, S, it's LEAPS. It stands for long-term equity anticipation securities. And it's a way to buy the option to buy a stock at a later date. They have expiration dates that are much longer, again, than the standard options contract. So why should you buy a LEAPS options contract instead of stock? There's a few reasons why you should consider LEAPS options. The first is buying LEAPS options over stocks gives you the ability to control a large number of shares utilizing much less capital. This is because when you buy the option contract, you're only paying for the right to buy the stock, not the actual shares of the stock themselves. Another reason to consider buying LEAPS options is that they offer limited downside risk. This is because the most you can lose is the amount that you paid for the LEAPS options contract. So you may pay $500 for a contract on, say, ABC stock, which is trading at $20. If the stock ends up going to zero, the most you're going to be out is $500 because that's what you paid for the contract. If you own the stock instead, it would have cost you the full $2,000. So you would have lost 4 times as much if the stock tanked and went to zero. What are the benefits of LEAPS options? There's several benefits to LEAPS options. As we mentioned, one benefit is that they can be purchased at a fraction of the price of the underlying stock. This means that you can get exposure to a stock for much less capital outlay. Another benefit is that they provide more time to see your trade play out in comparison to a shorter term options contract. This can allow you to hold on to a position in a stock that you believe has long-term potential, but it's currently undervalued. And as previously mentioned, LEAPS are also defined risk trades. So the max loss is limited and it's known when you put the trade on. Lastly, LEAPS options can easily be managed and rolled out in time if they're not profitable right away. What type of stocks are best for LEAPS options trades? There's a few factors to consider when choosing stock for a LEAPS option trade. The first factor is the price of the underlying stock. You want to choose a stock that's trading at a price that you're comfortable with and you think the price will increase. I like to use LEAPS options during a market correction or bear market when all stocks across the board have been hit. This is a time that you can go ahead and pick the best-in-class stocks in sectors that have been hit hard, but they're expected to rebound in the future. Another factor is the liquidity of the underlying stock. You want to choose a stock that's traded on a major exchange and has high daily volume. This will help ensure that you're able to exit your position when you need to. Lastly, I look for stocks that are not too high priced. This makes the cost to control 100 shares much less. So I'll go for a stock like Ford, ticker symbol F, at $11 versus a stock like Costco at $490. What is the optimal way to put on a LEAPS option trade? There's a few steps to putting on a LEAPS option trade. The first step is to choose the stock that you'll want to trade. As we mentioned above, you want to choose a stock that's trading at a price that you're comfortable with and you think the price will increase. The second step is to choose the expiration date of the contract. You want to choose an expiration date that gives you enough time to see your trade play out. I like to go out for 1 year or more when placing the trade. Often I look to go out about 2 years, and I find that you don't pay that much more for going 2 years than you would just going 1 year. The last step is to choose the strike price of the options contract. The strike price is the price at which you will buy or sell the underlying stock if you exercise your option. I recommend going deep in the money. There are a couple of reasons for going deep in the money. First, it will reduce the time premium that you're paying. The time premium is the amount that you pay for the options contract over and above the intrinsic value. What this means is that you're getting a deal. I'll show you in the upcoming example. The second reason is the delta is closer to 1 when you go deeper in the money. Delta is the amount that the option price will move for every dollar move in the underlying stock. So if the stock moves up $20 and the delta is 0.95, then the option will move to $19, 0.95 times $20. What this means is the trade moved $190 to the upside. You can then look at the amount invested up front and calculate the ROI, or return on investment. If you paid $1.90 or $190 for that LEAPS option, then you just made 100% return on your investment. Let's take a look at putting on a LEAPS options trade in XLF, which is the financial ETF. Banks have been down. Currently this stock is at $32.05. It's been as high as $41 over the last few months, actually this year. And banks are expected to do well moving forward with interest rates increasing. So let's go to the Trade tab on the Tastyworks platform, and let us look at the, let's go 470 days, so out past a year, and we will look at the, let's look at the 20. The 20 option is $1,280. See what it is at 561 days. It's the same price. So let's go 561 days. And we'll go to the 20 option at $12. The mid price is $11.70. So we're going to pay $1,170, or somewhere between that and $1,290. We'll see where it trades at. But we'll pay that, which is much less. It's basically a third of the price to control 100 shares. It would cost $32.07, which is $3,207 if we were to buy the 100 shares or one contract, 100 shares outright. So we will look at this. Let's take a look at where we will be profitable. We then look at the Trade tab, and you can see here as we get above 32, the price, our profitability increases. If we went up $10.42, our profit at expiration would be $1,040, as you can see right here, which is a great return. So almost 100% return if the stock price increased $10. So we will go ahead and hit review and send, and then it will debit our account. And if I hit this again, send order, the order will be placed. And that is how you put on a LEAPS options trade on the Tastyworks platform in XLF. How should you manage your LEAPS options trades? There's a few things to keep in mind when managing LEAPS options. The first is that you should never invest more capital than you can afford to lose. The second is that you should always have an exit strategy plan before you enter the trade. This will help you avoid being caught in a losing position if the stock moves against your expectations. When a stock does move against my expectations, I take another look at the fundamentals, the technicals. I look at the last conference call to read the report. I look at the news and see why the stock is down. If something changed since I put on the trade and I no longer like it, then I'll go ahead and close that and get out of the trade. If nothing changed and I still believe the stock is going to increase, then I'll stay and hold. If I'm holding, time passes and I'm down to 1 year out in the days to expiration, then I'll look to sell to close. I'll then buy to open again further out, closer to 2 years, and go deep in the money again. You can often do this almost for free by paying very little, since the option that we're selling to close is still 1 year out. Time decay is our enemy in this case, since we're buying the option. So if we stay outside of 1 year, we're going to be closer to replicating the owning of the actual stock, and time decay does not even come into play. What are the risks with LEAPS options? There are a few risks with LEAPS options. The most critical risk is that the stock can go down in price. If this happens, you will lose money. The good news is that you will only lose the amount of money that you paid for the option up front. You'll likely lose much less money than if you own the stock outright. Another risk is that time decay can eat away at your position if the stock doesn't move in the direction that you expect it to. However, as just mentioned, we recommend placing trades 2 years out and managing at 1 year. This almost eliminates this risk. So in conclusion, LEAPS options can be a great way to trade stocks that you believe have long-term potential and are going to increase in value. They offer the same upside as buying the underlying stock, but with much less capital required and less risk. Remember to always manage your risk and have an exit strategy plan before entering any trade. LEAPS options can be a great tool for long-term investors and traders alike. Do you have any experience trading LEAPS options? Let me know in the comments below. Happy trading.